And the market rallied, consolidated, worked inside of this imbalance and into this breaker. We have a low, high, lower low. Last up close candle, extend that in the future, hits it here, hits it here. My eyes don't, I gotta look at it and see. I'm not sure if that one hit it too. Yeah, it did. So it hits it here multiple times. Okay. Now, this breaker is not a supply and demand zone. Okay. Sam Seiden and those who follow him, if they were to see that as a demand zone, okay, now it's no longer fresh. It's definitely stale bread now. It's a crouton. They would never use that logic. Okay. My PD arrays, as long as the narrative stays intact, looking for higher prices, these PD arrays can be reused. Okay, their sponsorship doesn't expire simply because it's traded to it before. We're in a large consolidation here, buy side here, the market rallies up, creates another area of equal highs, it drops back down. Where is it dropping down into? Inefficiencies here, and look real close. You see that right there? What is that? What is this little thing right there? I'll give you a second to think about it. What did I tell you ES was going to do? Go higher, right? Up into that gap. That's what these two blue lines are up here. Okay, that real liquidity void, which is the highest portion of that volume imbalance on the weekly chart. So if the market's going to gravitate up to there, we're not looking for shorts, folks. So we wouldn't look at this as a rally up into it to go short. We don't want to see that. So if we can see it go above it and close above it, it does it on this candle here, but we're on a 4-hour chart, so it's definitely going to do a close on an hourly chart or a 15-minute chart, but we're going to just do a top down. This fair value gap would be treated the same way I told you I would want to see the dollar index fair value gap to be an inversion fair value gap. That means that we see it go above it and then treat it as support. Look at the bodies of the candles. That's the narrative. That's the real story is in the bodies. The wicks do the damage. Yes, we wicked through it, but look where it closed. We traded down. Look at the bodies close right there. That's consequent encroachment. That's the midpoint of that gap right there. Here, let me make it nice and obvious. So 41.82 1/4. The open on this is 41.82 1/4. Oh, look at that. Now you're going to tell me, you're going to argue with me, okay? Dollar Menu Mentor, going to tell me that that's buying and selling pressure, that this happened to make that line up exactly right there. Really? Really? I'm sorry. I'm sorry that nobody told you in books before me. I'm sorry that you can't find it on your own. I'm sorry. But you have it now. So stop wrestling with me. You guys, you make arguments against me when I'm telling you something that works phenomenally and how these markets really book price. Inversion fair value gap. If you ever have an inversion fair value gap, and here's for your notes, folks. I was going to save this for the book, but I'll give it here today. If you have an inversion fair value gap like that, and you have a fair value gap that's just below that level inside of your dealing range, meaning you have this low to that high. This inversion fair value gap, we would want to see it trade through that because we're bullish. Buy side, this later on, we don't know that's going to form yet because we're here. It rallies through it. We expect, ICT, tell me how to know when the fair value gaps shouldn't close in. Here's one of those signatures. Inversion fair value gap. All this area should stay open, or a portion of it should stay open. Okay, so in other words, it would look like this. This is what you would anticipate as a fair value gap. Some of you would see this entry in this shaded area here. Some of my students would see this as their multiplier, meaning that they would go long when price dropped into it right there. Other students would see this and say, okay, I want to see it show me proof with the bodies respecting either consequent encroachment or the high of the fair value gap. Is there any body closing at the high? No. We do have a body close right here on this candle at the consequent encroachment. As soon as it does that, we now can trust that this area here should not be traded down into. Technical science, baby. Take notes. Take notes, Goldman Sachs. Okay, because this is the real shit. So this run here goes for what? It takes out the buy side liquidity. Now, folks that just simply watch one of my videos and they see the relative equal highs and relative equal lows that we like to target. We don't look at this as we can trust this as a short, typical retail idea. We want to see something that's going to be at a later time used as a long to go right back there and target those individuals. So this area here would be a buy side liquidity pool. Okay, so that would be a first partial. If a student would use this entry on this fair value gap, they could use this as what specifically? What kind of entry would that be? Right in here, what entry would that be? Institutional order flow entry drill. Meaning that you're only needing it to go to that level or just below it of this fair value gap. Trusting, because we have an inversion fair value gap here, that's going to support price if we get a signature showing that either one of these conditions occur. A body closes at the high or closes at the consequent encroachment. As soon as that happens, the algorithm will immediately spool and go the other direction and aim for delivery to the upside, going after buy side or in an inefficiency above old highs. Buy side's here. Did it look like it wanted to go in a hurry higher? I mean, my chart looks like this. Does yours look like that? It draws to this area here, right in here, and then what do we get? Open, immediate rebalance, bang, hits it. If you get an immediate rebalance, you know where it's going to go. I told you weeks ago that it was going to go up here. It's on YouTube, it's in Twitter, it's all over the place. We were going long. We were focusing on longs, bullish, buying, long. Where to? Right here. Right up here. Immediate rebalance. Even though we took out buy side here, guys out there trying to teach FU candles. There are no FU candles. Okay, that's not my stuff. You want to pretend there's a mythological creature out there called a FU candle? It's your business. But they'll say, okay, look at this. It's running up here. Now it took the stops. Now it's going to sell off. No. How do you know when it's going to take out relative equal highs and reverse, or when it's going to keep continuing? When you have a higher time frame PD array that has yet to be traded to. So I'm not going to look at these equal highs being traded to and then reject and go lower. That's just a partial, and I'm holding on, looking for higher prices and running into higher prices still. Now, what happens if it's trading like this on going into a Friday or Thursday, and we're getting into this area here, but doesn't quite get to the high? It could wait until the next week's Monday, or if it's a holiday, into Tuesday, okay, wherever we open up at. All these things have to be weighed out when you're reading and or trading. It's not just simply get in there and just hold over the weekend, because over the weekend there's enormous gap risk. Gap risk is the likelihood of a opening that is unfavorable to your position. For instance, say you're long and you're up 80 handles in a position you're holding for ES. It could open up where you're now only up 40 handles. Or, and better scenarios, it can open up and now you're up 120 handles right from the opening. And if you get something like that, you should just take your profits there because it's likely to come in and close in that gap. And you don't know, because you're probably just now learning, you don't know if it's going to fill that gap and continue higher or close that gap, sputter higher a little bit, and then careen lower even still.